Most businessmen are focused on building their business in the early years, in their 40s and early 50s. They don't focus on an exit strategy. That's one of the biggest failings. Let's have a look at a scenario here to get the concept. Here's land purchased for $200,000. You start a small company, you and your wife, with $100,000 of capital, and the husband owns this real estate and all the shares. The home is a red herring because, as you know, there's no tax on a home. Both husband and wife die in an accident. So what would the capital gains tax look like? So you have real estate now worth $600,000. The company that they started with $100,000 is now worth $400,000. The capital gain on the real estate is $400,000. On the company, $3.9 million. 50% added to income of husband. Tax payable at his marginal rate. We're going to assume 45%. If they qualified for the $750,000 exemption, or if he did, we could say the tax would be reduced to $798,000. However, that's not the way it's calculated. And the bottom print says technically the exemption doesn't work this way. It is a deduction in computing taxable income rather than a deduction from one's total capital gains. So we've just put it this way so it's easier to follow. So what would the future capital gains be? So what is it likely to be in the future? It's not a science. We can't calculate your future tax because A, we don't know when you're going to die, and certainly we don't know what future tax rules are going to be, and we don't know what future inflation rates are going to be. In our example, we had a present value of $4.6 million, excluding the home. What's the future value? At 10 years at 8%, it's $9.9 million, less the cost base, less the capital gains exemption if you qualify. You may be looking at about $1.9 million in tax. Let's say we look at another example of $21 million. You may be looking at this amount of tax. If your business is worth $10 million, you can kind of prorate it. So we can't exactly calculate what your tax is going to be. But with a good tax lawyer and a good tax accountant, you can minimize the tax, okay, and defer the tax. And one way of doing that is using an estate freeze. It can be a partial freeze or a full freeze.